Robert, AAA is saying that gas prices are up 22% from a year ago. And what do you attribute that to, and what are the expectations for the future this summer?
Well, I think we're in a new regime for oil. We've been talking a long time about this glut of a global market, all this floating, tankers floating around the world filled with crude oil. It looks like the supply-demand balance is shifting, and we can see that on the supply side with two key events. One is this slow motion train wreck in Venezuela, just an absolute disaster in terms of that country being able to maintain its petroleum infrastructure. The other is a quicker event in Iran, with President Trump has now indicated that he wants to withdraw from the Iran nuclear agreement and impose new sanctions on Iran. And so that will start to impede their production. And those are two key producers that are going to be impeded going forward. At the same time, demand is still pretty strong. We have a strong U.S. economy. We have global economy going. And so that supply-demand balance is starting to shift a little bit from where it has been. Oil markets are tightening up, and we've recently raised our year-end price forecast for oil from $63 a month or two ago up to $75 a barrel.
And when we see gas prices increase like this as we're going into the summer months and vacation time, how does that affect people's spending overall?
Well, that's a good point. You're absolutely right. We're hitting the peak driving season where people, load the kids in the car and drive to California and Florida and everywhere else. And the rule of thumb is that for every penny increase in gasoline prices, that pulls about $1 billion over the course of the year from consumer spending from other categories. And the most vulnerable categories, of course, are the discretionary items like restaurant sales, perhaps movie theater tickets, other entertainment type venues, hotels, the big theme parks themselves. I'm not expecting a dramatic result here, but this is something to keep an eye on going forward. And it doesn't affect the overall consumer spending bill because consumers are going to spend the money and that's going to show up in GDP, but it's going to start to impact the mix of consumer spending around the edges as gasoline prices increase. National average, as you said, already in the 280s. California, as you know, about $1 higher than that due to all the taxes. And so we're starting to see a little bit of heat coming from gasoline right now.